Lily Reuters. Patrick, thank you for joining us. I'd like to start with precious metals. Gold and silver prices have remained resilient despite higher interest rates. From a macroeconomic perspective, what's driving this strength?
Thank you, Lily. At a high level, precious metals are responding less to nominal rates and more to real rates, fiscal credibility, and geopolitical risk. While policy rates are elevated, inflation expectations and fiscal expansion have kept real yields from becoming decisively restrictive, which supports gold in particular.
So gold is less about inflation hedging now and more about systemic risk?
Exactly. Gold is increasingly behaving as a hedge against institutional credibility, sovereign debt sustainability, political polarization, and fragmentation of the global trading system. Central bank purchases, especially from emerging markets, reinforce that narrative.
Silver, however, has both monetary and industrial characteristics. How does that dual role affect its outlook?
Silver is more volatile, precisely because of that duality. On one hand, it benefits from monetary uncertainty like gold. On the other, it's exposed to cyclical demand from solar, electronics, and manufacturing. If industrial activity weakens, silver can underperform gold even in a risk-off environment.
Let's turn to U.S. trade policy. Tariffs have reemerged as a central political and economic tool. What impact do they have on inflation and global supply chains?
Tariffs function as a tax on imports, so in the short run, they are inflationary. More importantly, they accelerate supply chain reconfiguration. Firms prioritize resilience over efficiency, which raises long-term costs. This structural inflationary bias indirectly supports hard assets, including commodities and metals.
Some argue tariffs strengthen domestic industry and the dollar. Do you agree?
Only partially. Tariffs may support certain sectors, but at the aggregate level, they reduce trade efficiency and global growth. As for the dollar, its strength comes less from trade balances and more from capital flows, financial depth, and reserve currency status.
That brings us directly to U.S. debt. Federal debt levels continue to rise, and interest costs are becoming a larger share of the budget. How concerned should investors be?
Investors should distinguish between solvency and sustainability. The U.S. is not at risk of default in a conventional sense, but the trajectory is increasingly problematic. Rising interest expenses crowd out productive spending and limit policy flexibility, which markets eventually price in through higher term premiums.
Does that undermine the dollar's role as the world's reserve currency?
Gradually, not suddenly. Reserve currency status erodes through diversification, not collapse. We're seeing incremental moves toward alternative settlement systems, bilateral trade in local currencies, and increased gold reserves. These are signals, not tipping points.
How does this environment affect investor behavior toward gold and other precious metals?
It reinforces strategic allocation rather than tactical trading. Gold is increasingly viewed as a balance sheet asset, something that sits alongside currencies and bonds as a store of value when confidence in fiat systems weakens.
What about the argument that cryptocurrencies are replacing gold in that role?
Cryptocurrencies serve a different function. They are speculative, high-volatility assets with technological promise, but they lack gold's historical role, physical scarcity, and central bank acceptance. In periods of stress, gold attracts institutional capital. Crypto often amplifies risk.
Looking ahead, what key indicators should markets watch when assessing precious metals and macro risk?
Real interest rates, fiscal deficits, central bank balance sheets, and geopolitical escalation. I'd also watch foreign demand for U.S. Treasuries. Any sustained decline there would be significant for both the dollar and gold.
Finally, if you had to summarize the current moment for global markets, how would you frame it?
We are in a transition from a low-rate, globalization-driven regime to a higher friction, fiscally constrained world. In such an environment, assets that hedge against policy uncertainty like precious metals regain strategic relevance.
Patrick, thank you for your insights.
Thank you, Lily.